Hey, really quick, heads or tails? Heads, you get to double your money, and tails, you lose everything. Go ahead, pick a side. Got it? Look, I get it. Betting everything on a coin flip is obviously insane, but a growing number of people are doing the financial equivalent of this every single day, not because they're dumb, but because playing it safe basically guarantees you fall behind. This is why more and more young people aren't investing anymore. They're betting. In fact, I just read a story about how one trader uses this strategy to pay his rent every month. Others turn $12 into $100,000, or claim they've cracked a system that Wall Street doesn't want you to know about. So with prediction markets now replacing investing for an entire generation, we need to talk about exactly what's going on, why a tiny group is making millions, if there's a strategy that actually works, and how the biggest mistake happens before money even touches the market. Because once you're able to see this, you'll realize why 94% of people end up losing money. Although before we start, in the spirit of this video, I'll make you a deal. Heads, you hit the like button, and tails, you subscribe. Let me grab a coin. Well, I guess you gotta subscribe, and as a thank you for doing that, here's a picture of a koala. And also, big thank you to Surfshark VPN for sponsoring this video, but more on that later. Alright, so before we talk strategy and why some people lose everything, we need to talk about the gambling loophole. See, here's the thing. Legally, there's a very distinct difference between gambling and prediction markets, and this new classification has opened up a brand new world where people can now invest based on who will win the Oscar for Best Picture, if Trump says autism during the State of the Union, or, I kid you not, if Juul will relaunch its mint flavor. How is this even possible? Well, unlike gambling, which is a randomized payout structure fixed by the House, prediction markets operate under the premise of offering events-based futures contracts, which provides a marketplace for two people to speculate on which event is more likely to occur. The thinking here is that because the value of the contracts moves with market sentiment and there's no fixed house edge, you're not betting against a casino. You're just trading against people who think that they know more than you do. And at the end of the day, the entire purpose is to provide a financial hedge in the event a specific outcome actually happens. For example, let's just say you wash cars for a living and you make no money anytime there's bad weather. In this case, you could hedge your income by purchasing 2-cent contracts on the slim chance of snow. That way, if it doesn't snow, your business operates normally and you lose a small investment. But if it does snow, you get a 50x return, which is more than enough to offset your loss of income from washing cars. Now apply that thinking towards any financial derivative in existence, and you have prediction markets that are basically just gambling under the disguise of being event-based futures contracts. Of course, in their defense, Kalshi responded by saying that people used to say grain futures were gambling before the Supreme Court approved them and said that they were ultimately needed for hedging purposes. But let's be real, most people aren't doing that. Instead, you have traders that have turned $1,000 into $200,000 in just a few months. There are people you could supposedly follow who have a high success rate, and others just buy the events with 99% probability to consistently profit. However, as nice as that sounds, here's the reality. One report allegedly shows that Kalshi users lose money even faster than sports gamblers. And once I started digging deeper, I realized that this was just the very beginning. So if you want to hear something crazy, let's talk about 2026 investing. Even though it sounds like these platforms should be used as a portfolio hedge, that's not what's happening. Instead, retail traders are pulling back from the stock market because it feels like a losing game. So instead of competing in a system that feels impossible to beat, more people are turning to all-or-nothing bets where it seems more transparent and easy to understand, even if the odds aren't in their favor. For example, surveys found that many young traders would rather bet on things like the Grammy winners or a potential TikTok ban than analyze a PE ratio, because at least with the Grammy winners, it's something they understand and comprehend, unlike a financial statement that they were never taught to read. On top of that, in terms of where they're getting this money, as it turns out, betting dollars largely came from funds previously used for savings and long-term investments, and these numbers were way worse than I expected. For every $1 a household spent on betting, it put $2 less into investment accounts, with net investments falling by 14%. Now the reason for this is pretty simple. According to a Federal Reserve report, young adults are already a lot less likely to have retirement accounts or really any savings at all. So with almost nothing to lose, high upside, low probability bets could start to feel rational in a world of perceived scarcity, regardless of how much money they stand to lose. To give you these exact numbers, 70% of polymarket traders lost money, while only 0.04% captured 70% of the profits. And even though Kalshi doesn't care whether you win or lose, they do get a small piece of trading volume, which has recently amounted to over $1 billion in a single day. This is why one analysis believes that the bottom quarter of Kalshi users lost about 28 cents of every dollar they bet, compared with about 11 cents per dollar on other online gambling sites. Obviously, Kalshi responded to this, calling the report extortion and flat out wrong, but the analyst in question went on record to say that we stand for transparency, we stand for helping bettors, traders understand their activity across the platform, and we stand behind our data. Either way, it's evident that when the same phone that holds a brokerage app also has events-based contract trading, the mental barrier between investing and gambling pretty much evaporates into thin air. And when you combine that with the fact that people are losing faith in the traditional investing system, compounding feels too slow, and home ownership is out of reach, high-risk bets just start becoming more common. And that's the thing that almost no one's talking about. So in terms of which traders are actually making money from this, if there's a system that works, and how some traders consistently avoid losing money, here's where things get interesting. Because once you see the data, you'll realize the winners are not who you think they are, and almost all of these are predetermined before you even place a bet. However, before we go into that, I find it interesting that some of the biggest risks right now aren't always shown on a chart. Some of them are invisible, like how much of your online activity is being tracked, sold, or exposed while everyone is distracted by price movements. That is why I treat privacy the same way as I treat investing. Minimize the downside, don't overcomplicate it, and automate the boring stuff. This mindset is exactly why I use our sponsor, Surfshark VPN, all the time. For those unaware, they help keep your online activity secure and anonymous, whether you're tracking prices, logging into bank accounts, or just trying to browse the internet without them knowing every detail of your personal information. Surfshark VPN is able to do this by encrypting your online data, protecting your personal information, masking your IP address, and preventing hackers from identifying your city, country, and download history. Or I guess put more simply, a VPN is able to do this by swapping the real location of your device with a new one, giving you the ability to virtually travel anywhere around the world. Or I'm able to change locations to watch streaming shows that are only available in select countries. Even better, Surfshark's clean web feature also blocks ads, trackers, malware, and phishing attempts, allowing you to surf the web safely. Plus, they don't track, store, or monitor what you do online. This means there's no connection or activity logs, so that you could rest assured your activity is private. Without exaggeration, there's never a reason not to use a VPN anytime you're online, which is pretty much all the time. So if you want to get started, check out surfshark.com/Graham and use the code GRAHAM at checkout to get an extra 4 months for free. They also have a 30-day money-back guarantee, so there's no risk to try it out and just see what you think. Again, the link is down below in the description to get started. Thank you so much, and now let's get back to the video. All right, now before we talk about exactly who's making a fortune from prediction markets and which investors have the highest likelihood of making money, we need to talk about the gamification of investing. What's really interesting is that a few years ago, Robinhood was facing legal scrutiny for gamifying investing, and according to legal filings, as well as interviews with current and former employees, they say that the app was built on what appears to be a Silicon Valley playbook of behavioral nudges and push notifications that draw investors towards risky trading, which happens to make Robinhood a lot of money. As proof of this, in the first 3 months of 2020, Robinhood users traded 9 times as many shares as E-Trade customers and 40 times as many shares as Charles Schwab customers. They also bought and sold 88 times as many options contracts relative to the average account size. Now, in Robinhood's defense, they were the first brokerage out there to make investing fun. They got a lot of people interested in investing who otherwise wouldn't have cared, and they were able to reduce the trading fees down to 0. But you also have to admit, Robinhood is in the business of making money, and when they directly benefit by getting you to trade as often as possible, it makes you wonder, who actually benefits the most from this? And I'm going to tell you, it's not you, it's the brokerage. This is why research constantly finds that frequent traders tend to be in a significantly worse financial position than other investors, and over time, a constant speculation tends to mirror the exact same outcome as gambling, especially when you YOLO your life savings into Robinhood stock an hour before they reported earnings. So here's the shift. If frequent trading already pushes investors towards worse outcomes, what happens when you strip away even the illusion of long-term investing and ownership and replace it with straight-up events betting. At least with investing, you're buying into companies that produce cash flow. They hire employees, they innovate, and they build products to the point where the entire market could expand over time. But with events contracts and predictions, it's a zero-sum game. Someone has to lose for the other to be able to win. There's no expanding pie, there's no dividends, there's no long-term compounding. It's just an outcome. This is why Charles Schwab's head of retail investing said that while certain financial events contracts might serve as hedges, the lines become much more blurred when you move into sports and entertainment outcomes that have no correlation to someone's actual portfolio. Barron's put it even more bluntly. The art of investing is beginning to share space with the dopamine rush of speculation. The search for excitement, competition, and instant gratification has always been a part of human nature, but technology has made those impulses faster, louder, and easier to act on. So now with a third of Gen Z seeing prediction markets as the future, and believe it or not, as a part of their everyday life, the question then becomes, who's actually consistently making money from this? Well, I'm sure the first thought through everyone's minds is insider trading. Because, let's be real, it's probably everywhere. Some of these bets are so scary accurate that the chance of them being totally random or luck is pretty much impossible. For example, one trader successfully bet that both Lady Gaga and Ricky Martin would make an appearance at the Super Bowl. Well, guess what? Both came true. What are the chances? Or how about this? One trader made a very timely bet right before the US invaded Venezuela. Again, what are the chances? The same have applied to diplomatic outcomes. And strategies have even popped up to copy some of these so-called traders so that you could get a piece of the action too. But is it legal? Well, surprisingly, the answer isn't yes, but it's not exactly a no either, simply for the fact that these platforms act as a barrier of truth, where if an event is to happen, you'll want somebody to have money where their mouth is. Although legality is a bit of a gray area. The founder of Kalshi was recently asked about this on CNBC, and here's what he had to say about it.
So let's say you're a dancer, you knew what the situation is, and then you made a bet. It sounds like that would be considered insider trading, right?
If you go park in front of a Walmart and count the number of people going in and out to estimate their sales, it's not insider information. If you're an executive at Walmart and have the numbers beforehand and you trade on that, that is insider information, material non-public information. Same exact rules apply to a regulated exchange like Kalshi.
What if it's his manager who knows the lineup and tells his girlfriend who tells her hair salon? You can't go after his manager for sharing public information that's not something that needs to be regulated. You guys are the ones that are making bets.
Either this information can be public.
It's not material information that can't be shared. You're making it that by putting it on this betting platform, but they have no obligation to say we're not going to tell anybody our opening lineup because there might be money made on this other place that's now betting on this. That's not the responsibility is not on them.
Long story short, it's a mess, but here's the answer. Insider trading laws primarily apply to stocks and securities, which are regulated by the SEC. But prediction markets are classified as derivatives and regulated by the Commodity Futures Trading Commission. For this, insider trading is classified as a breach of duty, like a worker stealing company secrets. But the bar is incredibly high to convict, so for the most part, a lot of people just get away with it. On top of that, the founders of these platforms argue that for a prediction market to be accurate, you want people with insider information to put money on it. In this case, it's a tool for truth, and if you ban the people who actually know what's going to go on, it makes these markets a lot less accurate. But you know what? For legal compliance on this video, here's exactly what Kalshi prohibits. Anyone with material, non-public information, anyone with the ability to exert influence or control over the resolution of a market, or any employee or affiliate of a source agency. So if that's you, then technically you can't trade, although one thing is for certain. These prediction markets are incredibly accurate to the point where 4 hours before a contract ends, the leading outcome is usually correct 94% of the time. Or in other words, if someone has money at stake, even if they know something that others don't, it's going to be reflected in the market likelihood of happening and other people could act on it. This is why Robinhood's revenue continues to climb. So in terms of my own thoughts, the problems this causes, and why I don't think it's stopping anytime soon, here's what you came for. Overall, these prediction markets really favor insider knowledge. When it comes to this, information asymmetry is real, and the most active traders tend to be the most sophisticated. But when betting is wrapped up in the guise of investing, it's inevitable that some people are going to trade way more than they really should, which is going to lead to some pretty disastrous outcomes. Now, don't get the wrong idea, because personally, I have nothing against prediction markets, sports betting, whatever people want to do with their own money, on their own time, with their own free will, is none of my business. But it is important to draw the line that unless you have expert level knowledge on a very specific topic, it's probably a money-losing proposition long term. Like sure, if this is your entertainment budget, totally good. I do not care. But the stats when it comes to gambling is pretty bad. For example, in states where sports betting became legal, household investments declined, savings went down, retirement contributions fell, debt increased, credit scores dropped. Not for everybody, but for a meaningful subset of the population. Of course, I get it. I think a lot of people feel so far behind anyway that even if they're able to save up $5,000 and invest patiently over 8 years to double it, that's still not going to be able to be enough to pay their rent increases. Investing $100 a week won't buy you a house for 35 years. So why not take that $1,000 and put it on a 1 in 100 chance of making $90,000 next weekend? No, it is not mathematically rational, but when the future looks so uncertain, these bets look a lot more appealing. So my advice is this: if you're going to treat it like entertainment, treat it like entertainment. Set a hard cap, assume it goes to zero, and don't confuse a lucky winning streak with skill. But if you are trying to build actual, durable wealth, this is not a reliable strategy, purely because the people consistently making money doing this are either early, better informed, better capitalized, or just running strategies that you're not seeing. Let's be real, the edge doesn't sit positively here with the person just casually scrolling Twitter, making bets from their phone in their bedroom. That's why I think the biggest risk here isn't the bet itself, it's if the bet replaces investing. The truth is, as boring as investing could be, it's one of the only games out there where you don't need someone else to lose for you to be able to win. And that's the difference. Now, if you feel behind, I get it. Putting $200 in an index fund is not exciting and it's not going to make you rich overnight. But stacking boring wins consistently for 10 or 20 years will absolutely make a difference. And ironically, the people who quietly invest every single month while everyone else is out there chasing moonshots usually winds up with the freedom that everyone else is trying to gamble themselves into. So that's why I think if you just really want to hedge something, hedge your downside. Build an emergency fund. Pay down high-interest debt. Increase your income over time. Learn skills that could make you more money and give you more opportunity. Doing all of this is actually a real asymmetric bet that does move the needle and does make a very positive difference. And sure, if you want to place an events contract on something that you see, that you believe other people don't see, sure, I'm fine with it. Just make sure you cover all of